messed it up. Sorry about that. I know that affects people. I know people look for those videos and I forgot to hit it. Good morning, Jeffrey. Good morning, Cav. Good morning, Bob. Good to have you guys in here today. Going through. Good morning, Erla. Lou Dog, good to have you back. Black Prince, nice to have you back. Looking to do a little learning in a completely different time zone. I love it. What is today? Today is Tuesday, February 5th. And in about 1 minute, we've got medium impact news, the S&P CS Composite, 20 HPI, Man, that's a lot of letters, right? But it is medium impact, and this is something that could affect the movement of the market. A lot of people will take a look over here at forexfactory.com each and every morning. Some people will only avoid the red flag news. Some people will avoid both red and orange. Make your own decisions on that one. You can decide what it is you want to do. But anytime there is red flag or orange, higher medium impact, that potential for the market to bounce a little bit is there. And then everybody's favorite, CB Consumer Confidence, running joke in the room. It is the cheeseburger consumer confidence, where they go through and detect what's going on in the wonderful world of cheeseburgers. Good morning, Steve. Of course, that's not true, but it is medium impact, and it can make something happen, guys. So just being aware, every morning being aware, it gives me the opportunity to not trade when there's something impactful that could mess with the direction or the volatility of the market. Everything that I talk about today will come from the Nexgen software services page. Everything that I talk about, every rule that I discuss, every trade that I teach is going to come from the Nexgen page, specifically the trading guide. And I've already fast forwarded to the trade that we're going to talk about this morning. We're going to talk about what's called a high probability trade, and more specifically, a high probability trend trade, trading with the trend, trading with the direction, going with the market. We talk about this high probability trade for the first hour every day in my classroom because this is a trade where each indicator on every chart agrees with the rules for the trade. Guys, that means that your indicators are telling you, you have all the, it's taught in this room. If you can learn these rules, follow these rules, this is a trade that typically wins 70 to 80% of the time. There's a saying that confidence comes from the memory of success. So not only is this trade being proven, and you're going to be able to prove it, that it wins more than it loses, but there's going to be a level of confidence that comes from the winners that you're taking here. And when you're confident, you're more apt to stick with the thing that's bringing you that success. The real reason that we focus on this trade first, why this is our foundational trade, is because this is the trade that's going to teach you to read your indicators. This is the trade that's going to teach you to look at your indicators and be able to say to yourself, I have the advantages I need to enter a trade, or I don't have the advantages I need. I choose to stay out of this trade. Good morning, Miss Jen. What you're going to find is that about 90% of your day is reading indicators. About 90% of your day is doing nothing. And guys, I'm telling you, I was up 10 minutes before 5 a.m. Central this morning, and I watched the markets pretty much nonstop until 8 a.m. I had 2 instances where my rules were met. So I took 2 trades. One of them went to profit targets, the other one I had to manage out of because things changed. My chart reading told me that things changed, and I exited before I took a loser and was able to make some money on it. So 2 trades in 3 hours, guys, and maybe 4 or 5 minutes max in the market. So get used to doing nothing. Get used to sitting still. Get used to reading indicators and waiting for advantages, because it really is 90% of your day. And then 10% of your day will be spent actively trading. So we're going to focus on chart reads first. And once you begin to understand a few basic concepts, you will understand where the market is likely to continue. This is actually where your entry will be for that highest probability trade. You're going to understand where the market is likely to go. This is going to help you with profit targets, and you're going to understand where the market is likely to stop. And these likely to stop areas are what we call termination conditions. And these are big lines on a large chart that say, hey, this is where the trend may end. This is where the market may bounce. This is where it could reverse. Let's go through and make sure that we're not trading into one of those areas. So it's only 3 rules for the highest probability trend trade. You'll find that I try to keep the basics as simple as possible. Guys, there's a million ways to confuse yourself. There's a million ways to trade this software. I'm giving you the absolute highest probability, best of the best way to do it for the new user. And then from that foundation that you build, you're going to begin to find your own trades. So we're going to keep it very simple first. We're going to focus on 3 rules. When a rule is true, when it's met, it creates an advantage, or it creates the recognition of an advantage. These rules are descriptions of what needs to happen in the market to produce a pattern that has been proven to win more than it loses. So a trade is momentum plus a clear path plus an entry area. It's like a flow chart. If I have momentum, then I'll look for a clear path. And if I have a clear path, I'll go define my entry where that market is most likely to continue. These 3 rules come to be on only 2 charts. It's all it takes. You know, my brother and I spend countless hours every day trying to recognize patterns, looking for ways to do things better. He suffers from this syndrome, HBNS, that's called happy but never satisfied. And one of the things in the last 5.5 years that I've spent working with Nexgen is we always come back to the most effective way for most users is 2 charts and 3 rules, the high probability trend trade. Hey, Miss Trina, nice to have you back in here. Your large chart leads the way. Your large chart is a very big chart. It's a slow chart. Hey, Wayne, good to see you. It is a very broad stroke of a brush, and this large chart is going to define the direction of the market. It is going to define the momentum in the market. Rule number 1 must be met on that large chart. And rule number 2, defining that clear path, making sure using those areas is also defined on the large chart. And Wayne, you'll be happy to know that we are live and rolling in YouTube. Yep, I got it, man. I got it. Oh, yesterday was the worst day for me to make that mistake. I know that it was. But the offer still stands. If you need any extracurricular on any of that stuff, let me know. Guys, on the large chart, we're using the most current bar, like the first printing bar, to do all that hard work, to define direction, momentum, and areas. Your first 2 rules are met on 1 bar on the large chart. I'm telling you, it's a big, slow chart. It's hard to see anything changing, so these advantages kind of hold strong throughout the trades. The entry chart is a refinement chart. And what it does is it literally takes the inner workings of that 1 bar. And inside that 1 bar, very often, you'll see up to 20 to 30 bars. Let me show you a picture of it. And it's just a refinement process. You can see the black box around 1 bar. Inside of that bar is typically a retracement, a bounce, and a continuation when we're looking for the highest probability trend trade. It's this refinement using the smaller, faster chart that's going to allow you to pinpoint the best of the best spot for entry, that point where the market is most likely to continue. That refinement chart allows you to reduce risk dramatically, and that refinement chart is also going to increase your profit potential, because by using that refinement process, we can enter a little further away from our profit targets. So we're just going to use 2 charts for 3 rules, guys. The first 2, your foundation, momentum, and path. Once you understand those 2, it opens the doors for all the other ways to use the software. So let's keep it real basic and focus on those this morning, and then you'll learn how to define entries when those are true. We use 2 charts because they're just a reflection of who you're trading with or who you're trading against. The big charts define the areas, the direction. They're a large crowd. I want you to think of a parking lot full of men and women with deeper pockets than you, with more influence than you, with the ability to create trends, to establish momentum. This large crowd should lead the way. And they're going to get 66% of the job done for you. Your small crowd, this is just the entry crowd. This is the guys and gals that like to fight, and they still have a lot of money. So they have the ability to create what we call a retracement, or a little push that's counter to everything that the large crowd wants. So if the large crowd says we're going up, these guys try to go down. And if the large crowd says we're going down, these yahoos are trying to go up. But the cool thing is they typically fail in their fight about 70 to 80% of the time. Rule number 3 on that smaller, faster chart, embracing the small crowd, is designed to put you into the market, right where their failure is most likely to happen, right where the trend is most likely to continue. So we love the small crowd, but we want to trade with the large crowd. We want to go with the flow, to follow the trend, to trade with momentum. So this is what we're going to do today, and this is what we did yesterday. And the cool thing is this is what we're going to do tomorrow and every day for the rest of your natural born life, until it's so easy that you follow me. But until it is, let's ask a bunch of questions, guys. We're going to take this morning and we're going to learn the trigger line of the Fibonacci rules for when it's okay to trade. It's okay to trade when the rules are met, because the rules have been proven to win more than they lose, and you're going to learn how to prove that. When is it not okay to trade? When the advantages are gone, when the rules are not met. And let me remind you again, your rules, your plan is going to grow as you grow, but in the beginning, we're going to keep it best of the best for you guys. You have the ability to simulate. Everybody has NinjaTrader. Everybody has a 100% complete working copy of the software. I am going to give you a plan to follow. I'm going to teach you these rules and how to identify it and what they mean to you. Your job is to practice, to get in there and be willing to make mistakes so that you can grow from those mistakes. But the key is post your pictures in class, guys. Every time you take a trade, win, lose, or draw, and I would say especially lose, post a picture in the room. Take that picture. Talk about each of those 3 rules, your momentum. Talk about whether you had a clear path. Describe where you got in and why, and you can even talk about where you got out. I love that you do, because there's a lesson in everything that you present in this room. There is a lesson on your chart read, making sure that it's accurate. There's a lesson on your entries, making sure they had the least amount of risk possible. On your exits, making sure you got the most out of that trade without throwing caution to the wind. So every time you post in my room, it's a private session. It's just the 2 of us in the room. And guys, there's no limit on how many times you can ask for that private session. As long as you're doing your part and annotating the charts and telling me what you're seeing, man, I will give you everything in my arsenal to help you become a better trader. We're going to simplify this morning. We're going to focus on only that high probability trend trade first. Good morning, JR. Good to see you, man. Because it's your ability to read charts that comes from the understanding of that trade that's going to open the door for more trades. On the plan that I give you this morning, there will be 2 trades on it. And both trades are designed to optimize your chances of success, the best of the best way to take those trades. You need to know what looks you're going to commit to. I say this a lot throughout the day. Your rules are just a description of a pattern that repeats itself every day, every market. Your rules have been proven to win more than they lose. And that pattern is the look that you need to commit to. First, it's going to be committing to the individual looks, learning the rules, and then putting them together, learning them so they become easy, so that you recognize the pattern, so you don't hesitate, so you're confident. And that's where the second part of getting to where you want to be ASAP comes in, guys. First, you're going to post all your trades in class. You're going to get feedback on everything that you do. And then you're going to track those in the spreadsheet. So Nexgen gives you this spreadsheet when you download the software. You can find it in your Nexgen study guide folder. Or you can just steal the one that I just dropped into the chat box. And this spreadsheet's going to have 4 tabs to get you where you want to be. The first tab is the basic rules. And it's not even the entry rules, guys. This is strong triggers. and clear path, highlighted in green. Each of these pictures is annotated. It's showing you exactly why it's a strong trigger and what it means to you in terms of advantages, how to recognize it in the market. Same thing with a clear path. And then it also shows you what it looks like when your rules are not met, when that strength becomes weakness, when that clear path becomes what we call a termination condition, an area that could stop the market. So knowing the difference between the two is going to help you stay committed to understanding your rules. There's the client trade section. And this is pretty outstanding, guys. I've stolen over 400 pictures from you using momentum, using entries, using path, and just said, wow, this is great. Let me throw it into a spreadsheet for my new kids to study, to look, to go back and understand some stuff. There is the entry sequence for long and short trades, because this is futures, ladies and gentlemen. We can make money both ways. Step by step on that small chart defining where the market is most likely to continue. There's ideas on management. This will be in the plan, but there's pictures to go with it. Ideas when you begin to break outside of the very basic plan to help you manage a little more effectively. You're going to begin to see patterns, and everybody's different. Some of you will see patterns that seem asinine to the average user, Wayne, and some of you will see patterns that are just little extensions of what we're doing. And the cool thing is everybody has something that jumps off the page at them. Everybody has something that speaks to them. And your patterns might be completely different than what I teach, but it's your ability to read the indicators that's going to help you see these, and you're going to define that those patterns win more than they lose. And I coughed out Wayne's name because Wayne is the king of that. Wayne has taken the very, very basics and found the moves within the moves with his ability to study and go back and prove they win more than lose. And you're going to see a lot of that in his trading in this room. Know that when you see people taking trades outside of the high probability trend trade, it's their ability to read the charts, to recognize patterns. That's what's taking them to that next level. So focus on your chart reading. And then you're going to be able to build a plan. Guys, this is just a place for your pictures. Every time the rules are met and it's time for you to take a trade, it's the right pattern, drop it in the green section. Every time you have a management idea, an epiphany, drop it in the management section. When you start to see your patterns, there's just a section for that, guys. Learning to day trade is a task of repetition. It's doing the same thing over and over until that task becomes easy. I like to tell people, take 15 pictures a day, annotate them. Well, let's not get 30 people posting 77 charts a day. Well, you know what? Let's do it. Triple dog dare you. Just make sure they're all annotated. But if you take 15 pictures a day, 15 pictures a day is 300 pictures a month, is 900 pictures over the course of 90 days of study. It is difficult to see the same thing that many times and not be comfortable with it, to recognize it at a moment's notice. So make sure that you're taking all those pictures, annotating all those charts. The people that take the most pictures, that post the most charts, that fill up the spreadsheet, these are the people that are getting to where they want to be faster than the people who are not. And then there's the trade tracking sheet, guys. This is the final one. And I think this is the one that pays the biggest dividends, because this is just a trade journal. And if you were brand new to trading and went to the Chicago Mercantile Exchange and said, what do I need to do as a brand new trader? The first thing they would tell you is start a journal, track your progress. So this gives you your journal, guys. You can put a picture into the picture section. There's how to annotate it for the best feedback, how to paste it into the spreadsheet, turn it into a hyperlink, and there's the capture software if you can't seem to find it on your computer. But everybody that downloads software gets TechSmith Capture, guys, and it is a 100% free, easy to use piece of software. Literally has a giant red button that says Capture. If you need help with that, let me know. And then your job is to take the picture, to annotate the chart, to get the feedback, to drop the picture in, talk about your advantages, and most importantly, guys, type in a little, you can shorthand it, feedback from class. And what you're going to do is every morning, well, if you want to become a chart reader quickly, if you want to become a day trader quickly, every morning you're going to go back and you're going to study the previous day's trades. And you're going to ask yourself two questions. You're going to ask yourself what worked and what didn't work. And you're going to notice that the things that feel easy, the trades that you're relaxed in, revolve around those advantages that we teach each and every morning. And the ones that feel forced, the ones that make you nervous, those are the ones where you know you're breaking your rules, where you know you're fighting trend or maybe trading into areas. And the ones that feel forced and nervous are the ones where you move your stops, where you adjust your targets, where you don't commit because you're outside of your plan. If you do this brief historical study each morning, it's going to set you up for the day. You're going to be focused on the things bringing you success, and you're going to be focused on avoiding the things that are taking it from you. And then when we work together and you get that feedback, you're going to start to see the same feedback repeatedly. You're going to start to see maybe indetermination conditions 3 or 4 times, or fighting trend, or early entry. And what happens is this is your pattern that you need to work on. You're going to recognize this pattern. You and I are going to work on a plan to beat it, to get away from it, to avoid it. And it gives you something to focus on every day as you go into the market. My pattern for the longest time was trading in determination conditions. And it wasn't until I got the feedback in the room that John Novak was teaching that I not only learned to make sure that I knew what they were, but also some simple language to avoid them going into each trade. And that's exactly what I'll do for you guys each and every time. So we're going to get into this first hour. I'm going to remind you, it feels like a lot in the beginning, and it gets easier every day if you keep it basic. So we're going to talk about what the indicators are first. Every chart has triggers. Large chart, small chart. They both have triggers. And there's 2 triggers. There are large triggers, which are dashed. It's a slow moving average. There are small triggers. They're solid. It's a fast moving average. And yesterday we had a great conversation. So I'm going to throw this in here. Things that you can ignore if you're capable. You don't have to know what the math is to create these. You don't have to know who programmed them. You don't have to know anything about triggers except small and large to be able to tell the difference between the two. That's it. Triggers are going to work their way into everything that you do, and nobody's going to ask you to define how they're built. So we're going to use them first to define momentum. We're going to use them to identify termination conditions, and we're also going to use them to pinpoint extremely accurate entries. So the only thing that you need to know about triggers is that these are small and these are fat, or these are small and these are large, excuse me. That's it. And if you can do that, you're solid. And then we're going to talk about areas. Areas are on both charts as well. Depending on the chart depends on how we use them, but the names are the same. There are divergence highs, which is a magenta line that prints if there's a loss of momentum. There's a negative number associated with it. That negative number is a byproduct of the software's calculations to produce this line. The number has no value. It doesn't suggest that this divergence is stronger than that divergence or that that one is weaker than this one. It's just a byproduct. But what happens is the market goes up. On the second bar down, the market's, your software says, hey, Mark, hey, Lou, Ron, John, guess what? Momentum isn't following price. Here's a big pink line. That may be a termination condition one day. Same thing happens at a low. It's a cyan line. You're going to see red Fibonacci resistance. You're going to see mid bands. You're going to see yellow 1-to-1s. All we're doing is defining them. On a large chart, they can be trouble. On a small chart, they can be entries. We're going to talk about that. But just know the names. You don't have to know the math that creates them. You don't have to know who Fibonacci was or what he ate for breakfast. All you have to know is that these are areas. And now we're going to use trigger lines and areas to recognize the pattern of the highest probability trend trade. And everything starts on the large chart. The large chart leads the way. The large chart's the big crowd. The large chart defines direction, defines momentum, defines areas. So we're going to start with strong triggers because we want that advantage of momentum. The only way to have it is to trade with the trend. Little bit of a safeguard, to be honest with you. The trend is your friend, ladies and gentlemen. If the background behind the first bar on your large chart is green, the market's going up. If it's red, it's going down. If the market is going up or down, your job is to look for rules to be met to trade in the direction of the trend. Funny story. Some days I like to tell stories. Today I'm going to do it. My brother had a broker back in the 90s. And the broker called him one day, and they were friends. If you've ever met John Novak, he's friends with everybody he meets. And the broker goes, "Hey, John, I figured out a way to get $1 million in that trading account." And John said, "Tell me, what are you thinking, man?" And the broker goes, "Here's what I need you to do. I need you to fund it with $3 million, and every time the market's going up, go short. And every time the market's going down, go long. By the end of the year, you should be down to $1 million. But it's a true story. It's a funny story. But there's a lot of truth in it. So going with the trend, guys, follow the flow. In order to have strong triggers in an uptrend, both the small and the large triggers must be green. It lets you know that the triggers are up as well. Strong triggers in an uptrend mean that the small triggers are above the large triggers, that there's space between the two. And here's your little cheat code again. Think of scissors that are opened, because when the scissors are open, the triggers are strong. So let me get my little pin tool here. In an uptrend, everything is green, background, triggers, and then think about scissors that are open. You've got the ability to cut, the ability to get work done. Those open scissors in an uptrend, or those open scissors in a downtrend, separation between the small and large, the ability to get some work done. Open scissors let me know that the odds are favorable for the market to continue in the direction of the trend. Odds are favorable. And you're going to see that annotated on charts, OFM. And I'm going to tell you, strong triggers has nothing to do with areas. Strong triggers has nothing to do with price bars. Strong triggers is nothing more than small and large and that separation when the colors match. And then strength turns to weakness when the triggers close. When the smalls work their way inside, the scissors are closed. You can't cut with closed scissors. You can only take a stab at it. And when we have weakness, anything can happen up or down. So I'm a big fan of language. And every time you see strong triggers, I want you to say to yourself, the odds are favorable for this market to continue in the direction of the trend. And anytime you see weak triggers, I want you to say out loud, dang it, anything can happen up or down. It doesn't feel like the right time to risk my money. Guys, this is the best of the best. Strong triggers push a trend. Strong triggers can break key areas. Strong triggers will even cover some of the mistakes that new users tend to make. And it's not difficult to see. Separation means strength, and that market pushes up. Weakness right at a key Fibonacci area or not. Look how it pushes all the way back down. Strength, weakness, over and over. Strength, weakness. And you're just going to see it. And the cool thing is when you have strength on that large chart, it's going to look like those bars, that slow moving chart is sprouting a tail or a wick. This is price moving below the halfway point. This is that pullback that you see on a smaller, faster chart. You can go back historically and study these, circle these tails with that much strength and say to yourself, this is a potential entry. Let me compare it to the small chart. See if my rules were met. You're going to use this as a study tool. So from the point of separation till they close, 4 opportunities for a potential high probability trend trade long. From the point of separation to closure, 6 potential entries for a high probability trend trade short. You'd have to go verify on a smaller, faster chart, but that's your look, and that's how you're going to be able to study. So I always like to ask, and let's go through a couple markets. Maybe it happens on every one, maybe it doesn't, right? It does. This is, whoops, get back over here. This is crude oil. And in crude oil, you can see strength and you can see weakness in the middle of nowhere. And look how the market retraces. Isn't that outstanding? There is strength, there's a tail. There's strength, there's a tail. strength, tail, over and over. So I'm going to ask you guys, is everybody cool with that? It's not a difficult lesson to learn. Separation means strength. Colors have to match. Odds favorable momentum. Guys, this is our battle cry. Odds favorable momentum can break areas, can push markets, can cover mistakes. Odds favorable momentum is when we're looking to buy or sell. Awesome. 2 of you got it. I love it. Once I have a strong chart or strong triggers, once I have the advantage of momentum, my flow chart goes to termination conditions. If I have momentum, then I need a clear path. The only way to have a clear path is not trading into one of those areas that has the potential to stop the market. You're going to find that I use words like potential and may and could and might. You'll never hear me say should, will, guaranteed to, because it's the market. We're not in control of it. We're only trading patterns. So what's a termination condition? It's one of those horizontal lines on the large chart. That's all it is. It's blue Fibonacci support. It's red Fibonacci resistance. It's yellow 1-to-1s. It's a cyan divergence low line or a magenta divergence high line. It's any 3 divergences in the same price range. And it's a large chart midband if the large triggers are a full bar away. Take the time to learn the names of the areas that could stop the market. It's going to keep you out of a lot of problems. We define it with a comparison of the area and those trigger lines. So now the trigger lines are done establishing momentum. We're going to let them define termination conditions. And I want you to remember these lines on a large chart. This is where the large crowd is making decisions. This is where the market has the highest potential to stop, to roll, where fights happen. Which one? Large chart midband? JR? Man, JR, you're going to love this. Based on your question yesterday, I adjusted my PowerPoint and I've got a picture and an explanation for you put into it. I was actually thinking of you this morning and I modified the training materials to make sure that you got that answer. I had a feeling that was coming. So write this down on a piece of paper, ladies and gentlemen. Decisions are made at key areas. That's all you need to remember. The people in charge are making decisions at key areas. So the first step in defining an area as a termination condition is let price get there. Let your dynamic Renko bars make it to Fibonacci resistance. And remember, resistance can be a divergence high line, it can be yellow 1-to-1s, or it could be that red fib. When price reaches resistance, dynamic Renko bars make it to resistance. The only thing you have to do is say, where are my triggers? If your triggers remain below, both small and large, remain below that area of resistance, this is an area that could create an untradeable bounce. This is an area that could create a fight between buyers and sellers as they go through that decision-making process. This is an area that could break. And this is an area that could reverse the market, meaning that those large triggers go from green to red. Guys, if this area reverses the market, if this termination condition creates a reversal, it's what we call a strong top. And a strong top is the precursor to the highest probability trend trade you could ever take. A strong top is rule number 1 for multiple trades that you'll take beyond this high probability trend trade. So understand that when price reaches and the triggers remain below, rule number 2 is not met. Absolutely no trades into the area. Let's wait for the reaction. Price reaches Fibonacci support, a divergence low, yellow 1-to-1s. Where are my triggers? Do you see how the triggers remain above? Ladies and gentlemen, rule number 2 is not met. There could be a fight, a bounce, a break, or a full reversal creating a strong bottom. You never know what the reaction is going to be. That's a bummer for a lot of people. A lot of people love to say it should. A lot of people love to say it will. I want you to accept right now, you'll never know. You'll never know what the reaction is. And if it doesn't reverse, well then it probably broke. This is what it looks like when an area breaks. And I show this every day because it reminds you 90% of your day is spent waiting. When price reaches Fibonacci resistance and the triggers remain below, sit on your hands and do nothing. Wait for the reaction. It's a termination condition. No long trades into the area. This area is breaking. Guys, it breaks less than it doesn't. So as the market continues up, you get to a point where your small triggers have broken above, really smashed through the area, 3 or 4 points. As long as you have odds favorable momentum, as long as you have strong trigger lines, you can declare that this area has the potential to break. It's not broken yet. Rule number 2 is not met just yet, but there's a lot of opportunity in this potential to break area. But because it's only potential, you're going to have to manage a little more assertively. You're going to have to use your chart reading to protect yourself a little bit. But once the small triggers get above and the large triggers get above, resistance becomes support. That area is now broken. Your path is now clear, and it's going to remain clear until you reach the next line. This is where we're looking for the entry for the high probability trend trade. This is where you can trade the potential of an area to break, but you have to manage assertively. This one says, hey, let's just wait and see if they actually get through that area. Same thing to the down. None, potential, go until you reach the next area, guys. And this is consistent every day on every chart. Price reaches, yellow 1-to-1s, none of the triggers break through, big untradeable bounce. Back to those 1-to-1s, triggers don't break through, big untradeable bounce. Price reaches a divergence low, it does in fact have the potential, but it doesn't break, guys. They end up rolling and go in the next direction, all the way to the yellow 1-to-1s where they stop to the tick and create a big untradeable bounce. Look where that giant push down stopped. Right at Fibonacci support. Where did it start? Right at Fibonacci resistance. Ladies and gentlemen, you now know where the market may turn, where it may bounce, where it needs to break. All you have to do is kind of piece it together. Take that momentum, couple it with a clear path. There's another termination condition on that list, 3 divergences in the same price range. So on a large chart, it might take an hour for 3 divergences to show themselves, 3 losses of momentum. On a small chart, you'll see it inside of that 1 bar on the large chart. 1, 2, 3 divergences in the same price range may terminate the trend. And guys, you're going to see this on your small chart. It'll be the only termination condition on a small chart. And what this says to you is, hey, here's your heads up. Things appear to be changing. We're losing momentum an awful lot, even though this chart says we're strong. It's that refinement process showing you what the large chart can't. So if you see 3 divergences on a small chart, maybe you're looking for an entry, no short trades, no next trade. Wait for it to sort itself out. And then there's one more that was on that list. A large chart midband can behave as a termination condition. Guys, I took this picture this morning. What is it? Price accelerates and reaches that midband. It can be a tick or 2 off. These are averages. If your large triggers are a full bar away, if your large triggers are so far away that you could get an entire reversal bar wedged into that space, you'll know it because there'll be a reversal bar marker. And the triggers will be above it or below it. But this right here says your midband is a termination condition. This is the only time that it's a termination condition. And that separation between price hitting the area and where the triggers are, it behaves as a vacuum, guys, and it sucks price right back to those large triggers. One of the cool things about this software, and something that becomes very predictable, is that price tends to return to large triggers. So this lets us know when the midband is a termination condition. It is more likely to close that gap if it's coming from a weak top, if it's not a strong top or a strong bottom, because very often the market will stop at that midband, close the gap, and continue in the direction of the trend that got us up there in the first place. So JR, that's what it looks like when the midband is a termination condition. Those large triggers are a full bar away. If they're not, it doesn't qualify. Does that help? And just so you guys know, if you're studying that concept in trade tracking, where is it? Basic rules, termination conditions. Anywhere you see gap theory, is that same idea that if price reaches an area, whether it's a mid-band or a fib, and the large triggers don't follow, it's likely to close the gap back to those triggers. So JR, there's about 30 pictures inside of this spreadsheet. There's another one. And it's the same pattern over and over. Mid-band, one-to-ones, as long as those large triggers aren't following, it's more likely to close the gap. And it doesn't mean go long and close the gap, not yet. What it means is maybe don't take that short trade inside of that vacuum. Let it go back and close the gap, and then look and see what happens. So a lot of study opportunities there. And if you go back in the live market and you just scroll back, you'll begin to see it. See if we can find a good example. That's a pretty good one. Right to the mid-band, sucks right back to those large triggers. Back to the mid-band and fib, sucks back to the large triggers. It does it again here, over and over. This is something that you're going to see. There it is, closes the gap. So you begin to recognize this pattern, and what it does is it keeps you from saying, hey, look at that momentum, I'm going to try a trend trade long. Instead, your brain says, whoa, wait a minute, that's a termination. Let's let them close the gap and see what they do. So good lesson there, I think. And it's happening right now in crude oil. Price reaches the mid-band. Large triggers are down here below that reversal bar marker, right at it. There is room for a bar to get back down to them. Absolutely no long trades into that mid-band. And then the saddest lesson for most people. There's going to be times when your path isn't clear, guys, because the areas are stacked. These areas come from thousands of calculations, algorithms running. These areas are solid, but they do break. But there will be times when there's like fib after fib after fib, and you're going to say to yourself, I just can't seem to get a clear path. I can't seem to get my rules met, and you're going to be tempted to break them, and you're going to be tempted to take the trade anyway. Guys, this is 90% of your day, and it really is. It's okay to do nothing. It's okay to sit on your hands. It's okay to wait. I play Scrabble off to the side. I watch golf videos. I actually just bought a little golf simulator thing that's going to hook up to my computer that has a little club. I'm going to play golf when I'm waiting for my rules to be met. Because the futures markets trade billions every day. And guys, I have to make $400 a day to be in a six-figure income. You're playing Minecraft. I mean, it's perfect. It's so smart, Morgan. Because if you're playing Minecraft when the rules aren't met, you're not taking what we call avoidable losses. You're not giving money back to a market that isn't giving you what you need to have the advantages. So, rule number 2, guys, it's a byproduct. It was established because even though areas do break, when price reaches an area and the triggers haven't broken, it is going to stop more than it doesn't. It's going to lose more than it wins. 36 times. Termination conditions keep you out of a loser. 6 times where you had the potential to make money based on the rules being met. It's that 90%, guys. 90% of the time is doing nothing. So, let's ask. Everybody's comfortable that trend is defined by the background color. Green is up, red is down, right? That's the easiest lesson you ever get. Rule number 1 says that I must have strong trigger lines, which means that there is a separation between small and large triggers. It has nothing to do with bars or areas. Momentum is defined on its own. Once I have momentum, I have to define the areas. This is where areas and triggers come together. I have to make sure that price has not reached an area, and if it has, my trigger lines have gotten to the other side of it. No termination conditions, giving me a clear path. Guys, once you have these two, we're going to use that refinement process. You're going to define your entry, and your entry is going to be so precise, dare I say kick-ass, that you're going to use a limit order to buy or sell a pullback at an area inside of triggers, that you are going to define where that small crowd fight is most likely to fail, where the trend is most likely to continue. And you're going to do it with such accuracy that you're going to wait for the market to come to you with a limit order. You're going to say, come get me, small crowd. This is exactly where you're likely to fail. And it's going to be in an area. Fibs, mid-bands, or yellow 1-to-1s. And we want those areas to be inside of triggers. And this is a very key part. The gap theory, that mid-band as a termination, reminds us that price loves to return to large triggers, whether it's a large chart or a small chart. Price may return to the large triggers, whether it's a 5-1 or a 13-2. So your entry chart has the large triggers from both on it. There's your 5-1. Those are smooth. And then there's your 13-2, and they're called synthetic and they're step. So Lou Dog, when does it become okay to trade that crude long after it hits that mid band? Oh man, you ready? Sunday school answer. When the rules are met. When the rules are met is when I'm going to look for that long. So right now, you can see that there's momentum, right, Lou Dog? It's odds favorable, but you don't have a clear path. And do you see, where's my small chart? Do you see what the market's doing off of that mid-band behaving as a termination condition? It's pushing down. Right now it's pushing down. And then here's a little pattern, Lou. If it's not coming from a strong top or bottom, there's a really good chance that those sellers are going to look for that next area. Because now price is reaching resistance in 1-to-1s, so there may never be a long. We're going to let them close the gap, and then once they close the gap, we're going to let them make their decisions, Lou. Either they're going to try to continue up, they'll break above 52, we'll look for rules to be met, or everything's going to roll, and we'll just look for short trades. The cool thing is, I don't care if the market goes up or down. Doesn't matter. The only thing that I care about is having momentum and having a clear path and then defining my entry. You're welcome. I think it is too. If you keep it basic, Lou, it really is. So price may return to triggers, and all your large triggers are going to do on that entry chart, guys, is define where the retracement is most likely to occur. Somewhere between the large and the synthetic. This is where the small crowd is most likely to push. This is where the retracement is most likely to happen. There is a way to make that a little more consolidated, guys, and it's what we call favorable large triggers. Remember, the initial introduction to the rules is the absolute best of the best, the highest probability, the least amount of risk, the highest level of accuracy. Favorable large triggers does that for you. It just means that the large and synthetic are overlapping, like two snakes riding piggyback, which means that that box around them gets really small, where the market is most likely to retrace. And then when you stuff areas in there, those areas create a bounce, you'll have what we call the smallest window of opportunity, the least amount of space for retracement, the tightest area for entry. And then if you look at crude oil right now, so check it out. There's the box where the retracement could potentially go. Guys, that's huge. It could go to the large triggers on the large chart. It's already blown through the large triggers on the small chart. When's it going to stop? I don't know. So the further they are apart, the harder it is to tell where that retracement is going to go, how big it may be. The tighter they are, guys, this increases accuracy a lot for you. So let's do it. Once the rules are met on the large chart, I'm such a downer, right? He keeps talking about rules. Guys, let the large chart lead the way. Once you have, there's our large chart. Once you have momentum, once you define that the path is clear, we're going to let the small crowd fight, guys. And that small crowd fight begins with a reversal bar. So here's the order of operations. Once you get the reversal bar, once you get the signal for that retracement is beginning, define where it's likely to go, and that's the large triggers. So draw a box. You have large triggers and synthetic triggers on your entry chart. 5-1 and 13-2, guys. One isn't better than the other. They're both large triggers. So you're going to draw a box from the highest line of the triggers to the lowest line of the triggers, and that's where the retracement is most likely to go. That's where the push down is most likely to go. And then the tighter they are one on top of the other, the smaller this big box becomes. Is everyone with me? Wait for the reversal bar. Define where the retracement is most likely to occur, from the top of the triggers to the bottom of the triggers. You guys want to make that box smaller? Take some of the indecision out? Let's look for areas. Once you define the retracement, you need an area for the market to bounce off of. The areas are your brick wall. Price bars are your tennis ball. We don't expect them to bounce off of triggers. We're looking for areas. We're looking for fibs, mid-bands, and yellow 1-to-1s. And there it is, all caps, inside of triggers, inside of that retracement zone. So this box, from the highest area inside of triggers to the lowest area inside of triggers, this shows me where the market is most likely to bounce in the direction of the trend from the large chart. Guys, we just defined where the small crowd is most likely to fail. And they typically fail 70 to 80% of the time. So you're going to study this pattern, you're going to learn it, you're going to trust it, and you're actually going to activate a limit order. You're going to right click and you're going to say, come on, small crowd, get to me. Come to me 2 ticks above that highest point of support. And if you do, if you can get down there, if that retracement goes, you're going to be in a long position. You are going to be in a long position with the advantage of a market where the odds are favorable for it to continue up because of those strong triggers. You are in a trade with the advantage of a clear path. Nothing in the way to create a bounce, giving you room to your profit targets because no termination conditions were present. And you just entered precisely where the market is most likely to continue with that trend, with that momentum, with that clear path. Guys, this is your highest probability trend trade. This is the best of the best. This is the trade that typically wins 70 to 80% of the time. This is the trade that creates confidence. So we're going to define entries again, because defining your entry where the market is most likely to continue is going to be the segue to beginning to manage these trades. But first, large chart rules are met. Momentum and path. This is your core. This is your foundation. Once you understand those two, you're going to find a lot of ways to make money with the software. Reversal bar begins the pullback. It is not your entry. It just tells you to define where the retracement is most likely to go. Somewhere from the top of the triggers to the bottom of the triggers. The tighter they are, the smaller that box will be. It's likely to bounce off the areas. And you don't know if it's going to be the high area or the low area. But because the large chart has odds favorable momentum, because the large chart has nothing to create a bounce, your job is to activate a limit order 2 ticks above the highest point of support inside of favorable large triggers. Is everybody with me? Can you give me a why? This is your entry for the long trade. This is what it's going to look like after the fact. Learn this pattern. Guys, you'll start calling your moves. The market will be like over here. And you'll be like, come on, reversal bar. I know exactly where my limit order goes once you study this pattern a little bit. Any line, any fib, any mid-band, any yellow 1-to-1, any area below those triggers in a long trade is the wrong side. Once you blow through the areas inside that retracement zone, your advantage is gone. Rule number 3 is no longer in play. And once you get to the wrong side of those triggers, ladies and gentlemen, you don't know if or where that market may stop or bounce. Rule number 3 is no longer in effect. Everything says down on the large chart with momentum and a clear path. We're going to wait for a reversal bar. We're going to let the small crowd fight. The reversal bar is not your entry. The reversal bar tells you to define where the retracement is most likely to go. That's your trigger lines. And then you define where the market is most likely to bounce and continue with the direction of the trend. That's the areas inside, or in this case, the area inside. One line where that market is most likely to continue, where that small crowd is most likely to fail. you guys will have the confidence to activate a limit order 2 ticks below it and dare the small crowd to come get you. Any line on the wrong side of the triggers, any line beyond the triggers. Fibs, mid-bands, or yellow 1-to-1s beyond the triggers, beyond the retracement zone, beyond the areas most likely to create a bounce. This is not a part of your window. This is not where you want to be in the market. You have no idea if or where it's going to stop once you get to the wrong side of the triggers. And guys, that's what's going to take you to your initial stop placement, because you just defined where the market is most likely to continue. Now you understand where the market should not go. And that language is important. Should not go. Doesn't mean that it won't go, but if this is going to be one of those winners, it should not go there, because that's where your initial stop is placed. Generally 4 or 5 ticks above those trigger lines. Above for a short, below for a long. And guys, that's going to be your initial stop placement. So it's imperative that you learn this pattern. It's imperative that you understand momentum, that you can identify a clear path and a termination condition. Guys, once you can do the large chart work, the rest of the trades begin to show themselves. Your entry comes from a small chart. That's the only thing the small chart does, guys. It defines the areas inside of triggers so that you know where to place your limit order. Terminations are not defined on the small chart. Don't let a small chart line talk you out of a beautiful trade. Termination conditions, areas, are defined on the large chart. And if you haven't reached it, you're good. Don't let the small triggers on the small chart scare you. That is a tiny time frame loss of momentum, and almost every trade you take, they will turn red against you for a long or green against you for a short. Remember, momentum is defined on a large chart. The only thing the small chart does is define the areas inside of favorable large triggers. And guys, if you circle that tail on a large chart after the fact, and it lines up with an area inside of triggers on the small chart, congratulations, you just found the highest probability trend trade. You found the best of the best. You found the least amount of risk, the highest profit potential. This is your pattern, and this is what I focus on for an entire hour every morning. And remind you, keep it basic. Learn to identify momentum. If it takes you a day, if it takes you a month, learn to identify momentum and commit to it. Once you have momentum figured out, identify termination conditions. Be able to recognize them, commit to not trading into them. Notice that we don't even have an entry. Learn one, go to the next. Learn the next, then define your entry. And then what happens is you just piece them together for this amazing pattern. I'm going to give you the keys to the kingdom so that you can do this faster than the people that preceded you. This is the chart reading 101. And guys, you're going to get all of this stuff in the room. Because the goal is that you first look at your large chart. You identify momentum and path. Have I beaten that dead horse enough yet? This is the core of your education, guys. Understanding these two concepts open the door for more opportunities. Ron just showed a beautiful one. Take 25 pictures each. There he goes. Back to that picture taking. Take 25 pictures each and take the time to explain why the rules are met or the rules are not met. So all you have to do to get to where you want to be in the beginning, guys, don't even worry about it. Look at that. Gap theory worked. JR, do you see it? Guys, open up your large chart and take a picture. Isn't it cool that you didn't get suckered into a long trade there? Isn't it awesome that you didn't have to lose any money because one simple pattern kept you out of trouble? That's what we're learning, guys. So watch this, one picture. I'm going to draw an arrow, and I'm going to say, all red, scissors open, strong, odds favorable momentum, rule 1 met. What do you guys think? Pretty easy, right? There's your look. I don't reference the bars. I don't talk about divergence. I don't talk about the areas in the distance. It's just separation. And I can do this. Smalls and large below support. Support is broken. My path is clear. Rule 2 met. I don't talk about the momentum. They're separate. But there's two great looks. I could even do this. How many lessons can you get in just one pictures? In one pictures. I pluraled one picture. Oh, I just crushed my Snagit editor. You guys get the idea though? Go take 100 pictures. It'll pay dividends more than taking 100 trades that you're not sure why you took them. If you need help with it, if you're taking those pictures and you're like, I don't even know if this is strong triggers. This is the high probability trend trade checklist, ladies and gentlemen. It is designed to give you the highest probability, best of the best, greatest chance of success entry for the high probability trend trade that you could ever take. How cool is that? And it starts with the market coming from a strong top or bottom. You can take the trade without. It's not one of the 3 rules. But this one adds some warm fuzzies. If a no triggers through termination, and guys, this is such a key point. Absolutely no triggers through that area. And let's talk about triggers breaking an area. Your triggers are 2 lines to create the small triggers. I want you to think of them as the front of your car and the back of your car. Your area is the brick wall you're trying to drive through. And if you don't get the back end of your car through that area, your trigger did not break that area. Does that make sense, everybody? So when you're defining strong tops or bottoms, if both sides of the triggers get above, you got your triggers through the area. If the back end doesn't make it, guys, it didn't break. It can still be a strong top. And then it's not a strong top until it reverses the market, until the large triggers go from green to red. So this one had 1, 2, 3, 4, 5, 6, 7, 8 bars. 8 bars before that termination condition became a strong top. 8 bars where the only thing I could say to myself is, don't go long, Mark. Just don't go long. First it's a termination. 4 bars later it's a strong bottom. Now I'm looking for my rules to be met. Best of the best. Do I have odds favorable momentum on both charts? Do I have separation between the small and large? Are the scissors open or are they closed? When you're taking your pictures, guys, you know exactly what you're taking pictures of. Has price reached an area and the trigger's not broken? Is it a termination? Should I wait? Does it only have the potential or is it broken? Guys, when you can define what you're up against, you know how you need to manage a trade. Defining your entry all the way to the point where your order goes and where the market should not if it's going to be a winner. So the first page is pictures. The second page is the high probability trend trade checklist. I would encourage you to print this out, to go back on market replay, to practice this, to hit pause before you enter to make sure your rules are met. Nobody in the history of this checklist has ever done worse than 70%. Nobody has presented me performance lower than 70% when all 4 were marked truthfully yes. I've had engineers run it through the ringer, guys. 83.2. It's either 83.2 or 82.3. I transpose those numbers every time. I don't want to lie to you. But a gentleman named Grant ran it through a 400-day study and was in the low 80s. So print this out, put it on your desktop, police yourself as you get into a trade, and write these on a chart every time you take a picture. Use the language, area inside, no terminations, odds favorable. Feel good about those trades and everything that you're doing. And now I'm going to give you a plan. This is the KISS plan. This is the Keep It Simple Sunshine, or depending on it, Bob has a completely different version from the Army. Keep it simple, keep it focused, keep it basic, keep it easy, guys. This plan is a stepping stone in your learning journey. It's designed to optimize your chances of success with the high probability trend trade as you learn to read your indicators as a new user. You know what I'm talking about, Bob. So through simulation, study, class feedback, continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Guys, when you can read your charts, you'll see more. When you can read your charts, you'll manage differently. When you can read your charts, you'll recognize more opportunity. Until you can, this is designed to keep you safe. This is designed to keep you focused. This is designed to give you the best of the best. And there's two things that you need to know before you enter a trade. As a brand new user on Simulator, who cares? Break all the rules. Just post it in the room and let's talk about it. You need to know why you will enter. Why will I enter a trade? Well, poor Lou got the answer earlier. When the rules are met, right? I'll enter when the rules are met. So Trina, remember when I said we're doing the best of the best? Optimize your chances of success. This is the sexiest trade you could ever take. It also says from a strong top or bottom, doesn't it? But you don't have to have a strong top or bottom to take a high probability trend trade. But Trina, if both of your charts say odds favorable momentum, isn't that better than one of your charts saying odds favorable momentum? If both of them are likely to continue? So what we're doing, Trina, is for the brand new user, we're trying to optimize. We're trying to give you blanket rules to keep you focused on the highest probability of success, because once you're successful, that confidence kicks in and you're going to work your way outside of it. You'll know when to use exceptions. Can you get a pic of what? Of me? I'm a handsome fella. Be careful. It's not fair to Trina, Wayne. Get a pic of what? Yeah. Both charts, odds favorable momentum. That's not it. It's interesting. So how about if we do this? Both your small and large chart have separation between the small and large. If the large chart rules are met, that would be odds favorable momentum on both charts. It's that trigger line. I'm going to find the picture, Wayne. Strong, strong. Do you see it? That's just the best of the best. It means both charts are screaming down. Is it your only look? No, of course not. It's the best of the best. It's the best of the best. It's the warm, fuzzy, happy moment that makes you feel good about everything. So, did that help, Trina? That was good, I hope. Awesome. I love momentum. It's hard to stop momentum, guys. Know why you're going to enter a trade. And in entering a trade, guys, your rules are a description of a pattern that is proven to win more than it loses. You've got to verify it. You've got to trust it. And once you do, you'll never miss it. You'll never hesitate. And you won't care what happens because you know that pattern wins more than it loses. So every 10 times you take it, you know it's going to lose 2 or 3 times, and you're okay with that. And you accept it as a cost of doing business, and you know that it's a normal part of a positive equity curve. The key is making sure that you're trading the pattern, because when you deviate from the pattern, you also deviate from the potential win percentage. So you also need to know why you're going to exit. Gary, once a trigger line ends, can you show me a picture? Triggers shouldn't end. They should be on your chart always. Could you show me a picture of what you're referring to? I just want to make sure that sometimes I'm pretty artsy-fartsy and my brain doesn't always see what you're describing. I see it the way I want to see it. Do you mean a fib? Do you mean Fibonacci, the areas? Okay, so a little termination is going to pay huge dividends for you, Gary. You want to know the difference between these things. Let me get through this and then we'll talk about it. I'll show you something pretty cool. Why will I exit? Guys, exits are taken either at your profit targets or when the advantages are gone. So a great example of that is if you're in a short trade and you have the perfect entry and all of the advantages, and your small chart produces 3 divergences, that termination condition, that would be a reason to exit your trade before hitting targets, guys. Your advantage had gone away. Putting your stop beyond the trigger lines, your advantage has gone away. That's a reason to exit before. So you've got to know both of these, and then you've got to commit to them. So define your entry, and then you have to manage it. And managing is typically the scary part for most of you guys, because now you feel like you have something to lose, especially if you don't trust the pattern yet. So the management plan is based on 2 contracts. And Gary 416, as soon as I get to the other side of management, I'm going to drop a couple things in the room, and then I've got a picture for you that describes 100% what you're asking. Try not to lose my flow. I get distracted easy. Bore me. 2 contracts, guys. And the KISS management plan is designed to do 2 things: to help you understand and trust stop placement and to get you paid. Is there anybody that wants to be a day trader for any reason other than making money? I haven't met anybody yet, and there's going to be somebody, I'm sure. Guys, my goal is to make money. My goal is to get paid. My goal is to walk away from every day with positive equity that I'm able. So this KISS plan is designed to help new users do that. And it's 100% dependent on your ability to enter where the market is most likely to continue. So if my entry is 2 ticks below resistance inside of triggers, then my stop is 4 to 5 ticks beyond the triggers. Well, Mark, is it 4 or 5? I don't know. Make your own decisions, right? Try not to saddle you guys down. I use 5. I always use 5. I want to give it wiggle room. These are averages, not exact numbers. So, guys, if I enter at 34, my stop's at 49. That's $150 per contract. That's a $300 risk trade. Some of you are going to pucker up and pull a pleat right into that leather chair you're sitting in because of $300. You're going to know your risk before you ever enter the trade, guys. You can make the decision whether or not you're good with that, but that's where the stop goes. If you decide you're going to beat the system and drop it inside of that retracement zone or below those areas that could create a bounce, you're more likely to get stopped out and just watch it run without you. That's no fun. So your targets are predefined, 100, 200. If I enter at the right spot, then my stop goes here. If I don't get stopped out, I'm going to get confirmation that the market's going in the direction of my trade. So if that reversal bar prints in the direction of my trade, I'm going to redefine where the market should not go. My new stop will be 2 ticks above that reversal bar for a short trade, 2 ticks below for a long. And guys, now you have $30 risk. You went from 300 to 60. That's a pretty significant drop because of the precision of the entry. Targets haven't moved. They're still 100 and 200. So now I'm either going to get stopped out for a smaller loss or it's going to go to my first target. It feels good when it hits the first target because if it reaches it, one contract comes off automatically. Guys, we're learning how to get paid fast. And those funds go into your account. And with only 1 contract remaining, you're going to go to break even. I am going to encourage, I won't demand or suggest that you do, but I would encourage everybody learning how to manage trades, let the trades run out. Let either stops get hit or targets get reached. Go through this KISS plan and get comfortable with the idea that you're going to have to be uncomfortable during a trade. It may fluctuate 1,000 times right here. It may sit there for 3 minutes. Follow the plan and see what happens. You're on simulator. You're developing trust, guys. You have 0 risk, money in the bank. And if it goes to your second target, guys, that's a $300 trade. Your second target was $200 in the distance. That is a $300 trade. And $300 trades once a day is a $75,000 year. And does it work, or is Mark just full of crap? Well, let me show you something. Bum, bum, bum. Bum, ba, bum, bum. I'm going to have to kill Snag It and then come back to it. But I took one today. I'm gonna kill my snag. Oh, that's Excel. That's Chrome. Man, it's bobbing and weaving. There we go. In that task, get rid of that snag. Sometimes things gum up. Get rid of that editor. Close that out. You know what? I dropped it in the room. So I'm going to show you guys. I took this one in the room. It was... It was one of those potential to break trades. It came from a strong bottom. There was no divergence in strong triggers. I entered at the area inside of favorable large triggers. I took profits at 100. I took profits at 200. Guys, that's a $300 trade. And it wasn't long after that that the market reversed and went down. Great entries reduce risk. Great entries create manageable trades that increase profit potential. So I'm not just the president, guys. I'm a member. $300 a day. Crank it up to 400, 200 per contract, guys. You're in 6 figures. How amazing is that? So everything you need has been provided in this first hour. 2 things just dropped into the room, guys. You've got trigger line and Fibonacci rules for when it's okay to trade. They have been described. You have a place to study them, how to study them, where to put them. You know what they look like. You know what they mean to you. Now they just got to commit them to memory. You have the ability to simulate in 15 hours every week. And guys, this is the next gen magic. 15 hours every week. All you have to do is post in this room and wait for the feedback. And we will work on chart reads. We'll work on entries. We'll work on exits. We'll recognize the patterns in you that are creating victories and losses. You have a trading plan. A trading plan that has been proven to win more than it loses, guys. And now all you have to do is learn. That's the only thing I can't give you. The only thing I can't give you is the repetition. To go through, to do the work, to take the pictures, to fill up your spreadsheet, to ask for help. And guys, squeaky wheel gets the grease. I just dropped in the chat box the all you need zip along with the spreadsheet once again. Inside of that all you need zip file, guys, is the chart reading 101. It is that daily goals reminding you that you don't have to hit a home run every time you're at bat. It is the PowerPoint that I use to teach the room. It's the high probability trend trade checklist. It's the KISS plan. And then there's 2 little bonus ones in there for you too. There's one called the pictures you can take. I am so hell-bent on you guys taking 1,000,000 pictures. Take a picture pre-trade. When you set your limit order, take the picture. You don't have to annotate it at the moment. You're trading. Focus. But you're going to go back and make sure you didn't miss anything in your analysis. This is going to pay dividends. During the trade, did anything change? Stop movements. Again, there's no reason to annotate in the moment. You're going to come back to these and you're going to work on management. After the trade, this is where you're going to go back. You're going to show both charts, entry to exit, and you're going to annotate and write that thing up. This is why I did what I did. And then I think this one is one of the most important, the no trade. Because the no trade reminds you that you shouldn't be trading, that your rules aren't met. I put 3 no trade pictures in the room this morning. Your no trade pictures and your after the trade pictures are the ones that need to come into the room. Because sometimes your no trade pictures weren't really no trade. They were a little misunderstanding. Maybe you let a small chart line talk you out of a high probability trend trade, or maybe 2 divergences kept you out and you didn't allow it to be 3. So make sure that you're posting those 2, guys. You're going to get feedback on everything. And really the only thing that you need is to know what you did right and wrong so that you can repeat the things that you're doing right. And then there's one other in there because I'm the simple guy. This is everything that we have just discussed in the last hour. And this is called Trend Trade Simple. It tells you how we teach, the advantages, the rules, the charts you find them on, the indicators. So Gary, go learn the indicators. Learn their names so that you can use them with the rules. The advantages, how to recognize them, all the way down to the KISS plan, entries, how to study, everything that you need. And then one picture I'm going to share right now, and this is going to pay dividends when defining termination conditions. So Gary asked, if the fibs quit printing, are they no longer important? Or something, let me make sure that I got the question right. If the trigger line ends, does it end? So here's what happens. Your large chart has fibs from 3 time frames, guys. It has them from the 5-1. It has them from the 21, which is an even higher time frame that you're not even looking at. And then it has the native ones from the 13-2. So your skinny ones that don't extend, these are your smaller time frames. These are valid. The fat ones are valid. They won't extend either. The only ones that'll go all the way to the right are the ones that are native to the chart. Don't rank them. Don't say, it's just a 5-1, or this one's super important, it's a 21. Because look, guys, 5-1 stopped the market, 21 stopped the market, 13 stopped the market. Let price reach it, gauge it with your triggers. And then, Gary, there's one more picture that I'm going to put in here to show you the synthetics, the ones from different time frames, and the 1-to-1s, and your mid-band. They won't print above a bar that is active. So the bar has to print before that yellow dot moves forward, before that red fib moves forward another line. So don't get fooled into thinking that you magically have this clear path because it's 1 bar wide. Let it be 2 bars wide. Once it's 2 bars wide, any of these fibs are in the rearview mirror. So little just FYI on the software. Are there any questions as we head into the second hour? Are there any questions about momentum, about path, about entry? Not so much? Cool. One last thing to share, and then I'm going to take a break, guys. This is for you new users. Get your listening ears on. The key to all of this is having a foundation. I can't stress that enough, guys. Understanding the basics, and then each week compounding, each day compounding just a little bit, getting 1% better every day. So for you new users, you overachievers, you adrenaline junkies, I blanket you with very conservative rules. The recognition of advantages, a solid plan that optimizes your chances of success as you learn to read the indicators. So Trina, why do I say odds favorable on both? Because you're brand new, right? So for all you new users, all termination conditions are bad. And for you new users, no momentum sucks. Areas beyond the triggers, it's a kiss of death. Guys, it's blanket rules because it increases the likelihood of success. That's it. And they're not always bad, but until you have the experience to know when to use exceptions, it's safer that way. And if you're winning more than you're losing, guys, you're focused on advantages and you're more likely to repeat the behavior. But just like anything, the more time you spend with it, the more you'll see. And this opens doors for you. So learn the process that yields results, and the results tend to follow. That's where the KISS plan comes in. If you keep it that basic, if you follow simple rules, if you're okay not looking for all the trades, only the best trades, you can find an extraordinary level of success. Guys, I've had people in their first 30 days with Nexgen, their first 30 days as a futures trader, get funded in those prop firms, just learning and following the KISS plan. And I've been watching this for years. And the people that deviate away from simple, the people that want all the trades, all the entries, that have to be in every move, they struggle to find the best moves because they're more focused on the money than the process. So question everything. This is key. Question everything. If you don't understand, ask a question. If you're not sure, ask a question. If you're looking at your chart and you don't know what it means, take a picture of that chart. Ask a question. Guys, I don't duck questions. I don't not answer things. And if I don't have the answer, I know the guy that does. I grew up with him. I want you to learn. But I also want you, and this is for my wife, this is her favorite phrase, and it's so true. Give yourself a little bit of grace. Guys, we are all alphas in this room. There's no doubt in my mind. People that are drawn to day trading have found success in life someplace else. They're accustomed to being the people with the answers, not the people asking the questions. I want you to flip that switch, become a student. You're new. It's okay to be. Make some mistakes. Break a few eggs. Make an omelet or two. No, Cav, keep them coming, man. Don't you dare stop posting. Guys, you cannot monopolize the room. I won't let you. Nobody has ever posted too much. What was the count yesterday, Wayne? 77? Joe, you either trust your rules or talk to your therapist. You have to identify what you're fearful of first. What scares you? That's the thing. How do I overcome fear? Well, first you have to define it. Not all fear is bad. Fear is what makes you strap a parachute on before you jump out of a perfectly good airplane. So define it. And then is it real? Is it monsters under the bed, or is it a great white shark and you've got a bloody nose? Two very different scenarios. So guys, I'm going to take 5 minutes and go stretch my legs. I think it's important to walk away from your computer every now and then. You don't have to, but if you wanted to, knock it out. I'll be back in 4 or 5 minutes. When I come back, we're going to click on every chart that was posted in this room. And on every one of those charts, we're going to go back to momentum, path, and entry, no matter what kind of trade it was. And some of you, I'm going to take your charts and turn them into lessons that you don't need. Smile and nod. Let me do it, because we are a community here and everybody deserves to get where they're going. And you just happen to post a pretty cool chart that I can use. So I'll see you guys in 5. Go stretch your legs. Get into that second hour. I'm going to scroll up to the very top. We're going to start looking at pictures. And we're just going to see what you guys are up to. Man, a lot of pictures. Miss Jen got us going. It's 7:07 in the morning. Let's see what she has going on. Said that was trade from yesterday. She carried it over, brought it to the room. Most markets are tanking. Maybe the cheeseburger confidence was down. So Jen says, check it out. Here's a strong bottom, meaning that it was a no triggers through termination condition that reversed the market. It created odds favorable momentum with the potential to break. And she takes a pullback. And because this is NASDAQ, she gets in on the best side of the triggers, not against them. Rides the momentum all the way up. Jen, absolutely perfect. 100%. Strong bottom again. Odds favorable 50-50. Gets in after the market heads the direction. Out at trouble. Absolutely beautiful again, Jen. Momentum and path, guys. Once you can define it, once you can define momentum and path, once you understand what you're looking for, you're going to find a way to capitalize. Cav did the same thing. Cav says, check it out. Termination, everything says up, potential to break. I'm going to take a pullback to the area inside of triggers, and I'm going to get paid. There it is again, guys. We're seeing medium probability trades. Trading based on the potential, which means he manages aggressively, gets paid, gets out, doesn't wait to see what happens next. Nicely done, Cav. Pete, weak top, triggers down, odds favorable. I'm going to try and line up the numbers here. So all of this is going on up here, but you're in down here. Oh, no, you took one, entered 6 at 67. It's hard to tell where that was. 67. Looks like it's right in the mess of things. Get in on the way down to the fibs, get out at the fibs, let it break, take a momentum style, get paid, get paid. Everything is down, you wait for a confirmation bar, and you go down again. Man, Pete, nice trading. Guys, this is a great example. When everything is going down on the big chart, you're going to find a way. You're going to find a way on the small chart to capitalize. Nicely done, Pete. Rinse and repeat, right? Rinse and repeat. Andy Man, he's a NASDAQ trader. He says, check it out. I've got a large chart. I don't have the best momentum, but everything is screaming down, so I'll take a trend trade and I'll get out of trouble. Actually, you held for a long time. So guys, this is one of those instances where I say, your large chart has weak triggers right at a key area. What a great place to take profits. And that was an 11 point, $220 worth of giving it back by not respecting where the market was likely to stop. Guys, I'm telling you, you can compound profits and there will always be another trade. There will always be another trade. There hasn't ever not been another trade. Not in the history of trades, as far as I've been doing it. Triggers wide, down, momentum. You take a pullback right to the area, inside of triggers, and get paid on the way down. How easy, Cav? How easy. Everything says down, you take a trend trade to go down with it. Beautiful. Oh, no way. And everything says up, potential to break, so you take a trend trade up with it. Love it. Strong bottom, strong triggers, potential to break that fib, so you take an entry and ride it up. Nicely done, Cav. Putting on a clinic this morning, teaching the kids how to do it. Morgan, strong top, termination, everything rolls, odds favorable, potential to break, divergence, you're in on the way up and out at the right spot. So you've been getting destroyed on these lately, you said. So are you still getting destroyed on the ones without divergence, Morgan? I'm going to give, this isn't trading advice, guys. Okay, no. So Morgan, this is where patterns are going to pay dividends, right? I'm going to show you guys, and this is exactly what I have to do too with my own trading. I keep losing 50-50 trades. That's that potential to break when divergence prints. I can either hope it changes, stop taking them, or take them from a strong top or bottom with a confirmation bar so I at least don't get run the fudge over. So the market has stuff going on all the time, right, Morgan? And you know that this can be detrimental. We know because in the KISS plan, that 50-50 trade says divergence is a killer. It's one of the biggest reasons that these fail. And Morgan, if you know that that's true, and I know that you're willing, I love this, I'll skip, I won't worry about it because of a strong top. You've created that rule for yourself. But now, Morgan, that pattern isn't producing anymore, right? The wells run dry. That pickup line that you used to use doesn't work anymore. You're lonely. Used to be great, but now it's not. So now you have to make a choice. You have to recognize that it's not. Have you guys ever met the grumpy old men that say, well, that's not how we do it. That's not how we do it. Or change the course a little bit. That's you, Morgan. You know it's not perfect. Is there anything that says that you can't insist on a reversal bar from the area? Why? Because then it defines your risk, right? It'll cut your risk in half. It still might lose. You still might get slaughtered. But if you never get the reversal bar, you have at least eliminated that one from the losses. Does that make sense? It used to work. It hasn't been lately. It's a good look, dude. It really is. You got scared it was going without you too. It didn't hit your order and you jumped in on the way down, didn't you? I've done that. You have a few trades, but you're not even learning a new one, Morgan. You're saying, this is my rules, this is it. But because it doesn't seem to be winning more than it loses anymore, I'm going to make one adjustment. It doesn't change your ability to recognize a strong top or odds favorable or 50-50 or pullbacks. It's just you saying, let me pump the brakes. Let me force it. Let me force it to go. You're in control. That's the thing that we forget, guys. We take what the market gives us, but we're never obligated to enter. There are zero obligations to enter the market. The market doesn't care if you're there or not. So if you don't feel good about it, if you don't like the risk, if they won't give you a down bar, F them. Don't take the trade. You have that power. Cav, weak bottom. Everything is up and strong. And you said, I'm not going to take the trend trade because it doesn't feel right. It was probably down here somewhere. But with this level of momentum, clearing the fibs, I'm just going to ride momentum and make quick money. And guys, this is a look that's called the chili dog. When you've got momentum on both charts, when the path is clear to the next level of trouble, there's a lot of people that are just jumping in with momentum and trying to capture $100, $110, $115 and then getting the hell out before momentum is gone. And Cav, you did it beautifully there. And for those of you that are capitalizing on that look, you need to send Ron C. a thank you card, because he researched it, studied it, put it together, and prepared it for you guys. And there it is again. Once you understand momentum and path, you'll find a way to capitalize. Is that Morgan? That's Morgan. Everything says down, nothing in the way. Morgan says, ride it, take it. Morgan, that pattern seems to be working for you. And look at that, one for Ron. You think your fibs are broken? Why do you think that? Get with Jason, dude. Guys, you have access to the best tech guy in the world. Morgan, if you go to Jason and say, Jason, I think my fibs are wrong, will you take a look? It'll take him 2.5 minutes to either have you perfect or confirm that they're great. I love Jason, guys. I think he's such an underutilized tool. We're all so damn proud. I'm going to do it myself. Oh my gosh. I break stuff and let Jason fix it all the time. All right, Cav. Cav says, triggers clear, everything is down. He uses the triggers and it works out, right? Everything says down on the large chart, nothing in the way. And Cav, it's a little unorthodox. You're like, I'm going to get it and I'm going to sit through 3 divergences. But the large chart says, here we go, I'm going to go with it. And you did it well. You did it well. And then the grand poobah himself, guys, the king of the chili dog. When everything says down with momentum and nothing's in the way, capitalize. Morgan and Ron in cahoots on separate sides of the country, taking the exact same trade because of the advantages. That's the stuff that gets me giddy, is when I see you guys doing different, or in different parts of the world doing the exact same thing. Odds favorable, 50-50, no divergence. I always get weird about this look. Curious if this is a look that you like. Morgan, does it matter if I like it? So let's do this. I like this. So anytime I have a 50-50, the first thing I do, Morgan, why is that so small, is where am I coming from? And this is a weak bottom, right? It's not a termination that reversed the market. And then I say, do I have strong triggers? This is my thought process every time. The answer is yes, overwhelming. I have the best momentum ever. Do I have a clear path? And then when you start reading your charts a little bit, not only is it no, but it's no, and it's 2 areas not broken. So what I'm hoping is that both of these areas break with that momentum. And then Morgan, let's just go through the language. Wait for the reversal bar. The retracement could go anywhere in this zone, right? And the bouncy points are pretty huge too. So my brain instantly says, I love the momentum. I love these areas. It's not perfect. My money is worth perfect, or at the very least, confirmation of the move. So Morgan, we go back to that idea that if you're at odds, you're like, this is good, this is nice, I like this, but it's not perfect. Is there any reason with this giant window you can't take a confirmation bar? Because at least now your risk is defined. And you have room to get to the mid band, which may hold, right? You have room to wait for change if they decide to go all the way down here. Guys, if it's not perfect, it's okay to wait for a confirmation bar. Does that make sense, Morgan? Well, but Morgan, I want you to use the language. So often people they wait for the confirmation bar. I need confirmation, and that's cool, you can do that. But there's times, Morgan, when it's perfect, right? When you have odds favorable momentum, when you have no terms, when you have perfect, tight, high probability trend trade entry. Why would you wait for confirmation when it's perfect? You know what perfect is. Why would you wait for confirmation? And once you know what perfect is, you can look at it and say, well, shit, this isn't perfect. Now I need confirmation. Make sense? It's knowing when to use it, right? It's knowing when to use confirmation and when to get in at the area. It's a great look. It's not a perfect look. A little confirmation goes a long way for that one. I even like Wayne's approach. Wayne says, man, I really want to get at the mid band, but you know what? There's too much indecision below it. Let me put an order a couple ticks above it. And if they come back up for me, I'll get in and I'll use the bottom of that bar. And Wayne will jump into these trades with 5 or 6 ticks of risk. And he does it brilliantly. He does it so nice. He says, this is where I think it's going to go, but I'm going to make him hit it and start my direction, and then I'll take it. Wayne, I used your entry this morning, actually. Just so you can be proud. Guys, I steal from you all day long. Check it out, Wayne. I caught it on the way up. I love it. This is the S&P, and I don't normally trade the S&P, and I don't typically wait for confirmation. I usually trade the NASDAQ, but I was like, I'm going to take the Wayne entry, and it works. I like it, man. So good lesson there, Morgan, I think. Use the phrase, it's not perfect, right? Oops, we saw that one. Use the phrase, it's not perfect, and you'll be floored. We saw that one. You'll be floored at how often, not only are you focused on confirmation if you need it, but you're also saying out loud to yourself, it's not perfect, right? It's not perfect. Let me really be certain before I risk my money, because I've just defined it as not the best look. Week top, who is this? I clicked and then I didn't look. This is Wayne. Week top, odds favorable. Place sell market here, and didn't get it till all the way here. Wow, that was big. That was a quick move. That happens sometimes. And then when divergence printed, was it a 50-50? Kind of in the moment. It just pushed up higher. That was a tough one to manage from where you got in for sure. I love that. If it would not have slipped, I would have made first target and even money on the second. Yeah, and if I were better looking, I'd be on TV and have my camera turned on. So Yeah, it happens sometimes. And that's gold. Gold's temperamental. Gold can have those. I definitely have a face for radio. Um, Gold can be temperamental, and man, it got you. It got you. And it just made it unmanageable, and that happens sometimes. It's a great read. It's an awesome look. That was the perfect trade, and Gold just had other ideas. They said, you know what, Wayne's too good at this. Let's see how he reacts when we put him in at the bottom of the move. But it's a perfect read, dude. Miss Jen, everything says up, odds favorable. Waited for price to clear divergence. You really didn't though, Jen. If the price bar is dissecting divergence, you didn't wait for price to clear divergence. Price clears divergence on this bar right here where the back of the bar gets above divergence. Does that make sense? You jumped in at divergence while price was right at the trouble spot. And there's a tail and there's another tail before it clears it. But once it clears it, it's straight shot to your target. Does that make sense? I hope. For anybody in the room, does that make sense? If you're trading directly at a line, you didn't let price clear the line. It just didn't happen. Nice trade though, Jen. Really well done. And then chili dog, guys. Price clears, back of the bar gets below the line. Price clears, odds favorable momentum, in after trouble, out at trouble, base hits, pay bills. Amen. Did you guys know that your account, at the end of the day, if it's at $1,000, it doesn't know if you put it in there $100 at a time, or if you had two $500 trades, or three $300 trades and $100 trades? The whole goal is to get in and out of the market before the market takes it back. And Ron, you do it better than anybody with this chili dog trade. All right, not a new user trade. So this was another large chart mid-band play. Take some courage to take this entry as the market reverse triggers had rolled and you had odds favorable momentum to the upside. What a great chart read. JR, you're going to dig this one. So what did Pete do? Pete said, Mark, and actually Pete just said to himself, Pete, check it out. The trend is up, momentum is up, but price is reaching a mid-band. And then Pete's been doing this long enough to say, man, those large triggers aren't following. Does everyone remember the lesson that when price reaches a mid-band and the large triggers don't follow, it's a termination? JR, you were asking, when do I take the long trade? When can I take the long trade? When the pattern's done. Was that you, JR? Somebody. It may not have been JR. And I said, when the rules are met, right? No long trades. Pete says, I recognize the gap theory and the weak bottom. Let me get in on the other side of triggers. Let me get to the other side of that momentum indicator. I'll get out at the first sign of trouble. I'll wait for a reaction when the gap is filled, and if there is none, I'll hold it for bigger profits. 40 tick target. Little did you know 8,000 side sell contracts would hit the market right after your exit and drive it down another 40 ticks. It happens. Great trade. So do you guys see how when you learn to read your indicators and when you begin to recognize a couple patterns, you can find a way to capitalize? You can find a way to catch these next trades, these seemingly aggressive but more based on patterns trades. And Pete, that's beautiful. From start to finish. Beautiful. Is that the one you were saying, wait till you see the next one? Good use of that. All right, Cav. All right, I'm going to be a stickler. So how can you have a momentum trade if you don't have momentum, right? This is vegan bacon, ladies and gentlemen. There is no momentum on the large chart. There's only path. Can you give me a Y if you recognize that? Smalls are inside, weakness, anything can happen. All those phrases that we use. How can I call it a momentum trade if I don't have momentum at the spot where I'm pointing? Does that make sense, Cav? I don't know. Let me double check the picture that I used to teach the class that I've been using for 5 years. The only way you can have momentum, Cav, is if there's separation between the small and large. That's momentum. No matter which chart, that's your look, brother. You had this right here. Weakness, anything can happen. And when anything can happen, it does, right? You're welcome. And thank you for the picture. So, guys, I only do that because of the words written on the chart. Somebody may need that lesson. Cav jumps in. Cav says, man, everything is down. The path is clear. There's no signs of slowing. I'm just going to jump in. And that's exactly what you did. And then Cav, because of that loss of momentum, that's it. Because of that lost momentum, you got to pull back all the way to resistance inside of triggers, didn't you? So this is one of the reasons, guys, that when the momentum isn't great, you can get bigger retracements. Anything can happen. So you had to suffer through that. With this look and the clear path, Cav, I'm going to use this as a lesson that you may not need. If you look at Cav's chart, and if you go back to the idea that everything revolves around advantages, let me pull up that picture. And I'm just going to take these three. And then, Cav, I'm going to take a picture of your chart. And guys, this is a good lesson. This is why I talk every day about learn how to recognize advantages. So there's our 3 advantages, right? A trade is momentum, clear path, and entry. And even though this isn't a high probability trend trade, if you learn how to talk to yourself in these terms, it helps. So I don't have momentum, right? Which means I'm going to lean on clear path, which I have. I love it. So I'm also going to lean on entry because I don't want to give up 66% of the goodness, guys. And Cav, leaning on entry has you focused on getting in a little higher up instead of so far below. Does that make sense? You had 2/3 of the goodness. You forgot to wait for the third piece. And all that would have done, it wouldn't have guaranteed that it got there or that you would have entered. But with the loss of momentum and the loss of momentum, you can almost expect a little bit of a retracement. And then if it doesn't make it, you can always catch it on the way down, a little bit of confirmation. But that's more for new users. When you start talking to yourself, I have this advantage. I have that advantage. I don't have this advantage. What you begin to do is you start looking for the other ones when you know one is missing, right? Lose your sight, sense of smell. Gets better. So weak top, 50 bars up or down. I like it. Everything says down. And you're thinking areas, but you're not committed because they're on the wrong side, right? So you get in on the way down. You get paid at 100, you get paid at 200. Beautiful trade. Nice one, Wayne. So, Morgan, this is a good one for you. Wayne's given a lesson inadvertently. It's not perfect, right? Because the areas are on the wrong side, but there's so many stinking advantages. He said, I'll just force it to go the direction of my trade, and I'll put a stop behind it. I love that. Go do a little market replay tonight. Practice it. See how it works for you. Good one, Wayne. Good lesson. Where are we? Miss Jen. Odds favorable. Not waiting for price to clear, and that's why it went up against you. And then it clears, and down it goes straight to your targets. Nicely done, Jen. You may not be listening to me anymore in the room. I'm not sure. But I know you're trying to take these momentum chili dog styles. That line needs to clear according to the rules. You may have a different set of rules, but every time you write that it cleared, I'm obligated in the room to say that it hasn't. Cav, roller coaster, everything is screaming down. Not the best momentum, you get the little retracement and out. So, Cav, you don't even have to answer. How did you know it would be the synthetic trigger and not the large trigger? Because it was already inside of the synthetic trigger. How did you know it wouldn't go to the large? That it wouldn't go a couple ticks below that midband at the top? I love your stop placement. You didn't. So, that was a loaded question, Cav. Stop where the market shouldn't go on this trade? Stop beyond the triggers? And that's it, guys. Once you understand that concept where the market shouldn't go, it doesn't matter where you get in, from the bottom of this bar to the top of this bar. Your stop is the same. With this look, Cav's willing to accept the risk. That was kind of where I was going with that. Nicely done. All right, Cav. Again. Oh, I think this one. Everything says down, potential to break. There's that pullback right at the area, just on the wrong side of the fibs. And you get out at the trouble spot. Nicely done. Ooh, a rare Steve chart. And Steve's mad at me. Steve's like, you know what, Mark? Didn't have marking for you, but I like your feedback. These are a mini NASDAQ because they are automated. All right. Dun, 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 dun. Let me try and make it bigger. Figure out what you're doing here. Everything says up with momentum. Your first buy is with that momentum. And it's somewhere off screen, so I'm not sure where you entered here. And price stopped a little short of the fib. And you got out inside of the triggers with odds favorable momentum. So Steve, I don't know completely what your rules are. Is the white dash line a midband? Okay. So Steve, if you have odds favorable momentum and a clear path, and I know this is automated, does getting out inside of that retracement zone make sense, right? There's your trend trade. There's your deeper push, no divergence, everything says up. I don't know what the automation is, so I'm not sure how you do it. And then everything is still going up. You get in on the way up off of the midband. And then it turns into a trend trade again. And profit. Yeah, if you're gonna buy and hold, why the exit? You're already getting above trouble, right? Why the exit? Predetermined? Okay, 40 ticks. That makes sense. Cool. So let me give you a little NASDAQery. And are you writing this, Steve? That's pretty awesome. I'll take people smarter than me for 500, Bob. Probably large triggers, Kurt. More room under the large triggers where the market should not go. So Steve, you can use this or not, but I'm going to give you a little bit of NASDAQ goodness here. So on the 13.2, when these triggers come down strong, right? And they're coming to entry areas. So whatever your entry condition is, getting in on the correct side of these triggers is always beneficial. You may want to consider stops behind pivots. It might reduce, actually that's probably what that was, stop behind a pivot. And you could literally just chase those large triggers up in a strong trending. You don't have any fibs on the small chart. I like it though. It seems like the premise is right. Large triggers up, strong triggers, predetermined. I'd say you're off to a good start. I don't know anything about creating auto systems. I don't know what Jason's template from yesterday was. But I think that the first victory is you're trading with trend and direction, right? You're trading with the trend, you're trading with momentum. I don't understand the entry criteria, I don't understand the exit criteria. But I think that if this is the look, that's a good start, right? Giving yourself, oh man, here comes the broken record. Giving yourself those first two advantages, giving yourself the advantage of momentum and path, and you'll find a way to capitalize. Good stuff, Steve. Let me know how that turns out for you. Let me know if I can be helpful. It's to trail pivots, so that's why that one got you, huh? Why no re-entry? So I guess that would be a question, right? No, that one probably wasn't a 42 target. That one looks like it was a stop. That one got you because your entry was right there. Why no re-entry? Does it not take the second chance? I'm just having fun with this. I'm asking questions that pop into my head. I'm not really critiquing because I don't understand. But these are the things that I would ask myself if I were building. Conditions were not true at 2158. 2158. Because of termination conditions? Right there, because you had the termination. And then your second entry comes as the small triggers break above. Okay, I like it. No, that's not stupid at all. That's how people succeed as day traders. Is insisting that their rules are true. Because your rules better be based on a pattern that wins more than it loses, right? So termination, all strong, pulls back to the mid band. You get in on the way down. There's your stop placement behind the pivot, and it just doesn't work. So Steve, 1031. Do you have divergence turned on the small chart? Dollars to donuts, you had 3 divergences right there in that range, possibly. I love the confirmation too, especially on the NASDAQ. I don't disagree at all. I'm just wondering if there was a condition that might have gotten you out, but it's automated, right? So you have to have winners and losers. You got to let it run. You got to see what it does long term. I dig it. I think that you're on a good path. So strong triggers, pull back somewhere to that EMA, somewhere to the mid-band, look for a close in the direction, and then hopefully it goes with the momentum. It's solid logic, Steve. It really is. It's one of the things that gets me about automated, though. I'm so used to being in control. Like I can look at it after the fact and go, oh man, I would have so been out of that trade. When those roll and those get above and it starts heading up, and you know, but you've got to let it run. You've got to let it run. Otherwise it's not automated anymore, right? All right, there's Cav. We knew one was coming, right? Everything says down. Larger down, smaller up, total termination condition. Cav says, you know what? From a weak bottom, from all these fibs, with the large triggers still down, let's see if it goes. Let's see if this area holds to continue down. And you give it a shot, and you just get out of the mid band, and you make a little bit of money. Definitely not high probability. Fights a lot, right? Very similar to what we saw. Very similar to what we saw Pete do earlier. So Cav, can I give you a little heads up on what would increase the likelihood of success? If you're just going to arbitrarily sell the area like that, gap. Having those large triggers a full bar away, because really what you're looking at here is it's screaming to the upside and everything's rolled and you're on the wrong side of everything, right? But if you get those synthetics way down here, then you've got that pattern that says, man, we're more likely to close that gap, and especially on the NASDAQ, not fighting those small triggers. Because you're fighting triggers on a 13-2 after 3 divergences with a trend change. There's a lot going against this one. That's the hold my beer trade. It worked, but I think if you took this exact scenario 100 times, you would probably find that it works less than it doesn't. You would probably find that you get run over more than you don't. Got in this trade, saw the large chart, there was a clear path. I don't see a large chart. Held on to the promised land. So you got in somewhere on the large chart and just held it all the way up to fibs. I must say, good job. I don't have any idea what your entry looks like, but I have to assume it was a little risky, because I don't see an entry down here on the retesting of support and close on the correct side of the triggers, which means you held through a lot of shenanigans to get up to that higher one. Might be testicular fortitude given to you through simulator. Really? Try to get on camera and it cut off, and the software won't let you try to take the same picture twice. Or will it? If you don't get the perfect picture, can you take another picture? Hold on, let me try. That's not the perfect picture. Oh no, yeah, you can. You can. But Cav, I've been doing this long enough to know that if you sat through all of this from the wrong side of synthetics, these triggers down, large triggers flat, something was going on. 1036. Let's go see. I like this stuff. Man, they've been moving, haven't they? Holy NASDAQ, what are they doing today? So 1036, you probably got in somewhere over here. Love it. 3 divergences in the same price range. Everything rolls, potential to break, retest support, goes up, retest support. And you found a way to capitalize. Pretty cool. Kurt. So guys, can I ask you something? And you certainly don't have to answer, but maybe you'll think about it. So many people tell me NASDAQ is untradeable. Mark, it's too fast. Mark, I can't move my stops. Mark, I can't make sure my rules are met in time. Why the hell do you guys keep trading it? If you can't keep up with it, why do you trade it? Thrill of the ride. Morgan, go tell your fiance her new jeans make her ass look big. You'll get all the danger you need, right? I don't ride them anymore. It became too dangerous. I don't ride motorcycles anymore. It became too dangerous for me to be out on the street. And Kurt, I like that. So I love the Nasdaq pre-market. The Nasdaq pre-market is a lot like the S&P and crude oil. I think it's pretty smooth. But there's this window between 9 a.m. Eastern and about 10:30 a.m. Eastern where the Nasdaq is crazy. I can't trade it. I can't keep up with it. I really can't. And guys, I didn't admit that for a while because it was a pride thing. I can trade it. I can do this. No way. I'd rather go to the S&P. I'd rather go to something that's moving. So watch this. This is the last hour in the S&P. This is the last hour in the NASDAQ. Guys, that's a huge difference. It's never boring. I agree. I agree. But, and I'm not telling anybody to not trade the NASDAQ. But what I'm saying is that if you recognize that you can't keep up with it, if you recognize that you can't get your stops in place in time, if you can't get your targets where they need to be, guys, it's okay to sit on the sidelines until you can. I could have never caught that long. It's a beautiful long. By the time I got in, it would have been time to manage. It is, Kurt. I get it. But it's also more likely to overrun areas. It's more likely to push through the perfect entry, which is why there's different entry rules for the trend trade. So there's 3 divergences from a high. It's just fast. I love the NASDAQ, guys. Don't get me wrong. It's all I trade. I just don't trade it off the open. I'm fortunate to have you guys to distract me so that I don't do it. Look at that range. This is where my brain says let it break out of the range. Hell, I took that picture this morning. I don't know where it went. Rule number 2, right? I took this morning. That was an hour's worth of the NASDAQ. Just nothing for me to do. Had to wait for it to break out. They're defining a range right now. I'll let it break out. I'm going to take a minute, guys. I'm going to go stretch my legs. And when I come back, Boaz, you'll be first. If you have questions, ask them. If you have pictures, post them. I'll be back in just a minute. I'm back. Let's finish strong. Look at that. They're still just trying, right? There's a fight. Buyers and sellers. We don't have to be a part of it. Boaz. Termination. Potential to break. Let's see. The first circle in a little bit late. Make a little money. Take the second one. Make a little money. Nice job, man. Termination reverses the market. Super strong. You find a way to capitalize. Absolutely beautiful. Great job. All right, Steve Diego. Some people figure out the NASDAQ. Let's see what you did. 92.20, 92.20. There's your entry bar. Not sure why you entered. All the momentum in the world with both trigger lines above the fib. Saw price go up, then back down at the time. Looked like Nexgen momentum trade. There you go. Smalls get above. You buy at the fib. Momentum trade, 2 contracts, 8-second trade. Beautiful. Nicely done. So this isn't the chili dog. This is a momentum trade. Letting the smalls break. Man, that was the smallest little snapback too, Steve. Really nice. Just quick profits. Gorgeous. Gorgeous. And then we come up here. Back of the bar clears trouble with momentum. Steve gets in. And it retraces a little bit on him. And then it comes back up. So with that level of momentum and nothing in the way, forward progress continues to be forward progress. Another good look. Man, gap theory. Large triggers a full bar away when price hits the mid band. Gap trade. And Steve, I love that you get in after the smalls roll. You let the smalls roll and get in on the good side of them to go close that gap. Nicely done. Great patience. And then out at the gap. Nice trade. We've seen those both directions so far today. And then from the termination, everything is up. Potential to break. You try the momentum trade. You try the next one. You get in on the next one. And eventually it goes. Holy smokes. Let me read it. Trigger lines on the 13.2, 5-1 above the fib, bought a pullback to the fib, Nexgen momentum, begged or exited reversal down with a 3-tick loss, with the loss momentum. Long off the fib, mid-band support, 50-50 trades. Better entries with reversal candle, price on the correct side of triggers, 6 contracts off at 645. Man, this is gutsy. If it works, it's beautiful. Steve bought every area on the way down to the lowest area. If this one fails, that's a lot of losses, right? Steve knows that. He made it. That's why he said better entry might have been the reversal bar. And Steve, honestly, with the small triggers this far away, this area is beautiful. You have room back to the smalls. Third entry is the highest probability entry. This entry is the, let me make sure it doesn't go without me entry. This entry is the nice momentum trade that failed. Dag nabbit. Let's see if it turns into a trend trade. Really nicely done, dude. Heads up. So Boaz, pre-market, I guess it depends on how you define it. I call pre-market anything before the open. Anything after the close. So there's overnight trading, which is from like 3:30 till whenever. I call it pre-market. I don't know if there's a clinical definition for it. I wake up around 5 a.m. Central. The market doesn't open for 3.5 hours. I call that pre-market. I guess it just depends on how far back you want to go, right? So anything after noon is technically before noon. So anything after the market closes is technically pre-market until the market opens. Does that make sense? I don't know if there's an actual... Now I'm curious. I love Google. I don't know if you guys know that. Pre-market is the time before the stock market opens when investors can buy and sell stocks and extended hours trading. So kind of the same thing. Cav, great trading today, dude. Really nice trading today. So in the US, they call it typically 4 a.m. to 9:30 a.m. So Boaz, there we go. We did get an answer. They consider it like 4 a.m. That's when the volatility begins to pick up. That's when the liquidity starts. So 4 a.m. until 9:30 a.m. Central, which is 5 a.m. That's about where I go. Good stuff. Thanks for asking that question. Now I know how to answer it next time. They're still stuck like Chuck, aren't they? Look at that. Grade A baloney, my friends. Crude oil just keeps pounding. Haven't seen it in the 60s in a while. And then, of course, the S&P is just kind of mirroring the NASDAQ at a slower level. Good stuff. S&P is coming off of that termination. Everything is rolled. Potential to break. If I got a reversal bar, could I define where the market is most likely to continue down? How about a couple ticks below that mid band in the retracement zone? You guys like it? Crude's down 240 ticks since the open. That's pretty big. What do you think, guys? Odds favorable. Now it's a clear path. If I get in at the area, lowest area of resistance inside of favorable large triggers, if they give me that entry, I know where my risk goes, right around 43.50. And the only thing I'm not in control of is whether or not they give me an entry. Does that make sense? Lou Dog, this is the pattern. Trina, this is what it looks like before you enter the market. Momentum and path. And I didn't even get a reversal bar, and I know exactly where I want to enter this market if they come back. That's what a little bit of practice does for you. Doesn't guarantee a winner, doesn't assure you that they won't just run you right over, right? But this is the pattern. It's been proven to win more than it loses, and look at this. There's my risk. My risk keeps getting smaller the lower it goes down. Let's see if they get us. I've got my KISS plan in. Let's see if we can run through one together, guys. I have momentum. I have path. I got my reversal bar. I've defined my window. The areas inside of the triggers, guys, that's it. That yellow box is where the small crowd is most likely to fail. That yellow box is where the market is most likely to continue if they make it. And I don't get to control whether or not they make it. I sure hope they do. They're trying, aren't they? Come on, small crowd. What do you guys want to talk about? Not telling you guys to take a trade. I'm telling you that if you were following rules, this is where your rules are met. If you are taking the high probability trend trade, oh, they tapped it. There it is. Let's put our stop where the market shouldn't go. Look at that, guys. Your first target is less than a full bar away. If I get a reversal bar, then I will reduce my risk. If I don't get a reversal bar, they're going to come hit my stop, guys. There's my first target and my reversal bar. Risk is diminished. First profits are taken. Second profit is at $200. Nothing has changed on the large chart. I love it. This is what we talk about every day. Pretty cool, right? You're already up 100. Oh, they got us. We made about 75 bucks on that trade. That was the KISS plan. It's still an area inside of triggers, isn't it? The only thing that should take me out as I adjust would be 3 divergences. Do you see how the rules were still met? Guys, you'll create a plan outside of the basics that revolve around these advantages. Look at that. We just hit our first target. We're break even on the first target. Maybe they come back for the next one. Never got 3 divergences, did I? Go S&P. There we go. Look at you money makers. What do you say we circle that tail? Fits the rules, doesn't it? And that was my bad. I should have been break even on that first one. I put my stop at an area inside of triggers, ladies and gentlemen. That was silly. So here's the deal. This is where I get cocky. Does it work? Hell yeah. You just have to learn how to work it, guys. That's everything I teach every day. Everything I teach every day. Kurt, good top, strong triggers, clear path, well, potential to break, pull back to resistance. Why did they stop you, man? You're still inside of the triggers. So Kurt, divergence was already there, 100%. Divergence was there before you ever entered that market. You got scared because it kept going up, right? You don't trust. That's where the market shouldn't go. And then I like that you got back in on the right side and still managed to capitalize. Dude, if you're not okay with the risk, don't take the trade. It's okay, man. I did the same thing, didn't I? Look at that stop. Looks ridiculous. We both did it, Kurt. Don't be like me. And look at that. Base hits pay bills. Ron doesn't take the trend trade. He takes the chili dog. Beautiful. Yeah, base hits pay for golf. Amen. Iron Mike. Hi, Mark. Hi, Iron Mike. I was doing the same trade you were, but didn't realize you were doing it too. Just listening to you in the background, saw you were doing it too. Your entry was 59.40.25. A little bit on the wrong side of the indicator. Pulled back 500 in the account. Rockstar, Mike. It doesn't have to be hard, does it? It doesn't have to be overcomplicated. It doesn't have to be a million working parts. And boy, they killed it, didn't they? So you waited an hour to make 500 bucks, Mike? I would do that every day. I would do that every day. Once you learn that skill, how to sit still and do nothing when there's nothing to do, that's when you're there. That's when you know. That's when you've got it. So there's kind of this path. I'm making this up as I go along. So guys, bear with me if I do something wrong here, but first, learn the rules, guys. I can't stress that enough. Learn to identify momentum. Learn how to see a clear path. Define your entry. Practice until it's easy. How do I get to where I want to be? There you go, guys. There's the keys to the kingdom. 100%. Learn the rules, practice till it's easy. That's it. Guys, the rules are ironclad. They're beautiful. There's a million trades beyond it. Mike made $500 in 4 minutes following the rules. So Mike, it depends on, you got to remember, I'm NASDAQ, not ES. So the KISS plan says $100 and $200, which is 8 ticks and 16 ticks. If I were in this trade in real life, Mike, my target, I probably would have taken my first one off. I like the $100. I like putting $100 in. But my second target would have been down here at $32.50. So it probably would have been about a $300, $350 target because my large chart told me that that's where we were most likely to go. Does that make sense? One of the things I do in my own trading, just to give you a little insight into my world, I'll show you an example of it. Well, there was an S&P 50/50 trade. I just did the KISS plan because it was for class. I take a lot of pictures. So this is a good example, Mike. So I take my entry, and when I'm trading the NASDAQ, I always get paid at $120 on my first contract. And that's just me. I love $120 because it means I don't mind keeping $100 risk on a trade. Because I'm trading when it looks like this. And then depending on the trade is what I do. So this is a 50/50 trade. It already had one divergence. So once I got paid at 120, I went break even. It's not a high probability trade. I refuse to keep any risk on it. If this were a high probability trade, I would have stayed below the pivot. I would have been willing to risk that money based on the look. So I let the large chart lead the way. But I'm a huge fan is that if your large chart, there's a good example. If your large chart looks like this, Mike, you're going to learn how to hang for bigger moves, right? You're going to say, gosh, with this look, with momentum, with a clear path, the only thing taking me out of this mofo is 3 divergences. Or hitting that darn fib. And this one went. I can tell you right now, that one did go to the fib. I remember it. Does that make sense, Mike? So start with some basics. Learn how to get paid, and you'll learn how to hold for bigger moves. One of the biggest things with the people that are in these prop firms, any Apex traders in here with that trailing drawdown? None? Yeah? It sucks. So guys, Apex, you better learn how to get paid. Apex doesn't reward you for big holds. Because if I get down here to 24 and it retraces all the way up here, even though I made money all the way down, it blows out my account. It's that trailing stop. One of the things I'm excited about with the Nexgen is I don't believe we're doing that trailing stop, or I believe you have the choice of whether you want the trailing stop or end of day. I believe, don't quote me on it. Yeah, we might be able to look. See if I can sneak in. This is our demo page as we go through and do stuff. My brother and I have spent countless hours. We are so close. We're hoping, fingers crossed, to beta test with some of you guys by the end of the week, is what John said. So we'll see. We'll see. But Mike, the one thing that I tell people is if you're not comfortable reading your charts quickly enough to decide whether you should be holding, oh my gosh, look at that. Whether you should be holding or exiting, keep it super mechanical in the beginning. Learn how to get paid. And then just, you know, when you get better, you'll get more. You'll add contracts. You'll hold longer. Don't rush the process. It's like snow skiing. I wanted to be an awesome snowboarder, but sometimes the blue slopes were too much for me as a new guy. Move too fast to bring your second target. So everything says up. Did you switch charts on me? Nope, that's your small chart. Coming off of the trend trade, you caught the little snapback, and it was too fast to get out and move for bigger moves. Nice trade though, Andy. Everything says up. The momentum is amazing. Didn't catch the trend trade, but with momentum on both and nothing in the way, easy peasy. Great job, dude. Nice trade. And then, Andy, remember the mid-band's only a termination if the large triggers are a full bar away. So once you get above this divergence high, it's kind of game on for that trade that you took. Good stuff, man. Nice trade. Letting the large chart lead the way. Look at that. Odds favorable, clear path right back to the mid-band inside of triggers. Dag nabbit, they did it again, guys. They did it again. You guys see it? Odds favorable, clear path, pull back to support inside of triggers. Your stop would be behind the reversal bar right now, and that's even late. And you probably would have already hit your first target. Made $100 and gone break even if you were in at the right spot. But there's your pattern again. Guaranteed a winner? Of course not. They might come get us, right? But that's your pattern. And if you got in at $37.75, you made $100. You went break even. You didn't get stopped out. Pretty cool, right? There's your second chance entry because 2 divergence doesn't kill it. KISS plan. It might win. It might lose. I don't know. All I care about is the patterns. That's it. Just care about patterns. So learn the patterns. Accept the results. I'm just getting willy-nilly here. I should probably stop that. I'm trying to find something to talk about. Because you guys stopped asking. Let's do this one. Nope, that's not the one I wanted to show. I want to show you guys this picture. The penalty box. This was developed by somebody that's been trading Nexgen for about 20 years. And the penalty box rules are a reminder that rules are everything, man. Rules are everything. So any violation results in a walk away from the computer, and that's what this person did. So whether it was missing a good entry all the way up to trading against trend and direction, when you understand what's detrimental, what is hazardous, what is bad, what happens is you start to hold yourself accountable to following those rules. So I thought that was kind of a good one. Then the experience curve. Have you guys seen this one yet? Sometimes I feel like this is scaring people, and I don't want it to. Experience versus time. In the beginning, it looks like fun, guys. Everybody wants to be a day trader because everyone believes that the second you have the software, you are 3 weeks out from your first Ferrari. And it looks like fun, and you're excited, and you have no idea what you're doing, but you're going to keep doing it, even though you realized, oh crap, I'm going to have to learn some stuff. Right around 30 days is when the average Nexgen user goes live too soon. 30 days is where I went live. This is actually kind of an autobiography for me. Right at 30 days, I had gotten lucky on Simulator about 10 times. I made about 5,000 simulated dollars. I had reset my simulator 1,000 times, but I chose to ignore all the resets. I only remembered the wins. So I went live, and I didn't go live with a prop firm. I went live with my own hard-earned money because I was convinced that I was ready to take the world by storm, and I got my ass handed to me. It was 21 trades in about 2 hours, and it was $5,000 gone instantly. And I had no idea why I lost. I didn't know why I entered. I didn't know where I was supposed to get out. And guys, I left that day feeling like I didn't want anything to do with Nexgen. I was mad at my brother. How could he give me this stuff that clearly didn't work? And I found myself in self-loathing in the I don't know shit stage. Pardon my French, but that's exactly where I was. And when I got there, something amazing happened. And it was funny because when my brother gave me the software, he said, Mark, learn the rules, write them down. Make sure that you have a plan. And then don't just do that. Practice them. Go take pictures. And he told me, he said, go take pictures of 10 entries and 10 longs and 10 shorts. Know what it looks like, Mark. Just know what it looks like so you know what it looks like when you're supposed to get in the market. And make sure that you're posting your trades in the class because you're going to make mistakes. I can't keep getting pictures from you on Skype. So post in the room and let me give you feedback. This is what my brother told me on day one before I'd ever fired up the simulator. And I didn't say it out loud. I wish I had. Maybe he would have corrected me. I thought, well, shit, I've been good at everything I've ever done. I've worked my way up in every job that I've ever had. I excelled. I'm kind of a big deal. People know me. My library smells of rich mahogany. And I didn't do any of it, guys. And I blew out. And then after I blew out, I remembered when I was feeling dejected, when I was angry, when I was upset, when I had to explain to my wife that I lost $5,000. I said, oh yeah, he told me how to do it. And guys, that's when I started on the path. So I teach this classroom kind of based on my own failures, if you will. I teach this classroom to help you guys ignore or avoid this downslide, this feeling of helplessness, this, oh my gosh, this sucks. Because if you start right here, and this is a great place to start in anything you do in life, and you follow that plan, you get to the I did it stage, and you can circumvent that $5,000 loss. You can avoid all that heartache. You can learn from my mistakes. So I love that picture. And this path has been solid and proven for nearly 30 years now. So it's up to you. It's up to you. And look at that. Sometimes they just push a little lower and then they go. Those sons of guns. Wayne, have a good one. I saw your message. I think most of the beta testing is going to be on TradingView initially until the platform is 100%. So you guys that are TradingView users, when we start looking for beta testing, John has written the indicators, have everything but fibs and Renko bars. So this is a 1 minute and a 15 minute, and we've come up with a trading plan for it. You can go through AMP futures, you can do all the paper trading, you can practice. It's pretty cool. You can copy, just to give you guys a little heads up, you'll be able to have trading accounts. There's a trading copier, lead accounts, following accounts. We've been testing this stuff for weeks now, and we're just getting the last little bugs out. There's stuff about evaluation counts, payment histories. I mean, everything, guys. And we're getting so close. So if you are a TradingView user, we may call on you a little bit. Lou Dog, how did you do today, man? How you feeling? Is it starting to come in a little bit? Samuel, were you able to keep it simple? Who else have I been talking to a little bit? Decrypt, I noticed that you're back in here. I know that lotus flower. Guys, remember, it's a lot to take in the beginning. I know that it is. If you allow it to be simple, it's easier. If you keep it super basic, it's easier. I know the rules for every trade Nexgen teaches, but it's been a good day. Right on, Lou Dog. Never argue with results, right? I know all the rules to every trade. I'm a trend trader. I love trend traders. I love momentum. I love path. They don't always work, but they work more often than they don't. So for me, it's a good deal. I like it. I feel good about it. It makes sense to me. Guys, Is there anything else you'd like to talk about before we call it a day?